Assalamualaikum, Sakib Sab. I see you. Can you please unmute yourself and turn your video on, and then I'll make you the co-host.
Assalamualaikum, Ali.
क्या हाल है आपका?
Alhamdulillah.
Great to see
How
you.
are things with you?
Things are very good, thank you. Today is a bright sunny day in London, which it wasn't in the last couple of days, so it changes our mood as well.
Bilkul.
Nice at your end as well.
Well, it's quite warm actually. Karachi mein to it's pretty much hot, I would say.
Are you in Karachi or in Islamabad?
मैं तो इस्लामाबाद में हूँ. यहाँ तो हर किस्म की गर्मी है, politically as well and weather-wise as well.
Unfortunate on the political side. I was in Islamabad in December and it was very cold. It was colder than London. It was actually colder than London. Not only did it feel colder because our house don't have insulation, but actually the weather temperature was lower. So Islamabad in a warmer time is much prettier. So I'm sure it's nicer as such. So it's 4:30 now, so we can start. I have made you the co-host, and as you know, we're delighted to have you talk to us and give us your insights. And of course, all of us on this forum know you, so I don't have to, in fact, know you very well. We have followed your research since many, many years. And always find it very insightful. And so with that, I just pass it on to you. Would love to hear from you in terms of how do you see the macro performing, and especially the report which you wrote, which was on Pakistan and the IMF program. So would love to get your views. And typically the format of this is that after you run through the presentation, we'll just open up for Q&A, and the audience were mostly investors from banks, asset managers, and family offices. They'll write questions on chat and I'll read it to you.
Thank you, Ali. Thank you for the invite and the opportunity to share my thoughts with everyone. And Assalamu alaikum and good afternoon or good morning, wherever you are, to everyone. What I'll do is, if you give me a quick second, I'll take you through a presentation based on the report that we produced. So Ali, if you can just let me know, is this on screen now?
It is on the screen.
Okay, perfect. So I'll just quickly run through this, but quickly in the sense that it'll take about half an hour. And then, I'd like to ideally leave as much time as possible for Q&A. So I'll do that. If you give me a quick second. So we're back full circle in many senses, as you can see from the title as well, and from what I put down in the report, as far as with the IMF is concerned, and also unfortunately full circle pretty much as far as the politics of Pakistan are concerned as well. So we'll talk about both these. They're interrelated, of course. But I think the important thing here, very quickly, housekeeping sort of notes in the sense that the situation both internationally as well as domestically is quite fluid. So you do keep in mind that this report or this presentation is based on a report which was finalized about 9 to 10 days ago. So things are moving much faster than we would like. And of course, they're changing some of the goalposts or some of the forecasts and projections we've made. But nonetheless, I'd like to start off with some of the key assumptions, so you can understand. This can anchor the rest of the stuff that will come later, and you can understand where I'm coming from vis-a-vis some of the forecasts and projections that I've made. So when I finalized the forecasts, I'd kept Brent at an average of around $140 for the next 4 months, March to June. And then coming down based on a number of reasons, and I've put them down there. A deal with Iran, the shale capacity coming into play, demand destruction in the US, Saudi and UAE spare capacity coming online, Venezuela, etc., etc., etc. And because of that, the path of oil prices that we have forecast is down a slightly moderating trend, average of $90 in FY23, and this is our fiscal year, July to June, and then $60 for FY24, because I think the demand destruction can be quite severe with what's happening. However, of course, as a note of caution is that things are very fluid, and we're really, it's all conjectural what we are saying about the future as we sit here in March. The other key assumption that I've made is, or had made, that was that this government is going to survive the vote of no confidence. And I think I've changed that since the report went into publication. But in the report, the implication of this assumption was that the policy mix will remain broadly unchanged. So the government, or the PTI government, will keep the fiscal relief package in place with all its attendant unintended consequences till June 30th this year. Beyond that, a few things in the policy mix will change, but the government's requirement to move towards a defensive policy mix, less accommodative fiscal policy, that impulse will not change because they would be well and truly in an election mode. Therefore, the policy mix will continue to wreak some degree of destruction, if you like, on not just the fiscal front, but also vis-a-vis the external account, and through that channel to inflation. Now, I'll talk about it a bit later, but I increasingly, as things have unfolded, actually a few days after the publication, I changed my mind that now I think the chances of survival of this government seem bleak, for reasons that we'll talk about later. But will that change anything? We'll talk about that as well a bit later. Nonetheless, for now, a critical thing is that the IMF program faces an impasse, and as a result, we will, the government will not be able to unlock that $3 billion that's remaining between now and the end of the program. And of course, there are certain other implications that we'll discuss as we move along. Now, the main takeaways from the report that we did for KTrade were, like I just implied, that there's a collision course with the fund that's been set up. It's very likely, it's probably already in play. And, of course, I'd like to emphasize, as Ali and some of you know, that, I'm an insider outsider in many senses, but all the things that I will be mentioning here, that I have mentioned in the report, none of them are inside knowledge. They're all in the public domain, or they're all based on my reading from the outside. So my view is that obviously the government is having a difficult time in the 7th review with the fund, and it's likely that the fund will probably walk away or give another pause to the program. And it's not just the fiscal side, which has been put under pressure by the government's relief package on subsidies, with subsidies on petrol and electricity, but it's the untargeted nature of the subsidy and the uncertain financing which have really raised the risks. And the problem is that the government is, of course, in dire political straits. So it's unlikely to offer any quid pro quo to the IMF at this point in time that may appease not just the staff, but allow the staff some wiggle room to take that quid pro quo up to the board. It's not happening because Pakistan has already missed some continuous structural benchmarks. And one of them, of course, this is causing the biggest I think, asked for the IMF staff at this point in time by media reports is the tax amnesty scheme, which the Prime Minister also announced. And that's a clear violation of our sort of understanding with the fund just a few months ago. So now, compounding all this, of course, there's high uncertainty across a broad front, from geopolitics to domestic politics to the outlook for international commodity prices. What we do know within this uncertainty is that Pakistan's gross external financing requirement remains elevated in the medium term. So initially, it's this year, and to some extent the next year, it's going to be the external current account balance, which is going to be pressured upward. This year, of course, it's already out of whack, and it's going to end up at a very, very high number. We'll talk about it in a few slides. But going forward, it's the external debt repayments which will kick in as well. They are elevated, and for the medium term. So that's going to put pressure on our external account. And as the commodity super cycle continues, of course, it will not just worsen the external account or the balance of payments outlook, but also the inflation outlook, and it will have a knock-on impact on growth. Are there any positives in the macro? Yes, but they're a bit far out, in the sense that Pakistan has crossed quite a few hoops of fire within under this government. Not as much as many of us would have liked or would have hoped for, but the government has moved, and this is really bizarre, because the opposition narrative is in the field. It's taken hold. Even I look at some of the names here of people attending this. Some of the most well-informed people in the financial markets in Pakistan, in other policy areas, and some of them have been ex-policy areas. But even within this select and elite group, the narrative has taken hold that the government was completely incompetent. And really, if you look at what they've done in terms of some key structural reforms, at least from my perspective, they've moved the needle in some key areas, relating to not just the central bank autonomy, of course. They were forced to do that by the IMF. That's a separate matter. But in terms of public financial management, especially, not on the expenditure side as much as perhaps a few things on the tax side. Now, Shabar Saab is here, part of this group. He'll probably vehemently disagree. But I think in terms of the number of new filers we've added on, and some other measures that we've taken with in terms of valuation, property valuation, etc., we have moved the needle somewhat. Maybe not as much as we would have liked, but certainly. Then there's trade policy. I think a lot has happened under trade policy. A lot has happened in the IT sector, which many of you are much more familiar than I am with. And some good things have happened with public debt management as well. But nonetheless, that's water under the bridge. The government has not been able to claim credit for many of these things, because all of this has been subsumed under the inflation, its inability to control inflation. And I think that's what's brought the government to its political demise. Now, just taking on some of these thoughts further. So if we look at Pakistan and the IMF, of course, it's been a troubled relationship for a very long time. We've had 13 programs only since 1988. And most of them, as all of you know, have not been completed. Very few have been completed, just a couple. So it's not a good relationship. And when you look at the outturns under this program as well, the total fiscal consolidation that Pakistan had to achieve from the start of the program till the end of the program was roughly about 2.6% of GDP. So far, till the end of this fiscal year, we were required to achieve 1.5% percentage points, of fiscal adjustment, and against that, we've only managed 0.1%. So clearly, even before the latest salvos fired by the government, we were off track by a fairly big margin. But we were getting a lot of surprising forbearance from the fund. Now, added to this is the government's curveball, and what they've done, of course, is that they've just pretty much on the cusp of the Russian invasion of Ukraine, they announced a package which was based on the existing exchange rate and pretty much the existing at that point in time the prevailing international oil prices, which are roughly about $94, and the exchange rate of 175. And they based this, so the calculation was roughly about 246 to 250 billion rupees that the petrol and electricity subsidies will cost. But clearly, since then, the world has moved on. And so this is a sensitivity of different oil prices and different exchange rate movements, what this package can cost. And it can cost pretty much about anywhere from 0.4% to 0.7% of GDP. That's the additionality. Now, the government does not have firm financing to counter this, even though the finance minister, was quite adamant. But I think, all the financing that they've pretty much listed, other than the cut in the PSTP, was something that, is up in the air. So the unintended consequences of this are, of course, we're already seeing many of them in play. It's going to be a widening of the primary fiscal balance, which is, as you know, the main performance criteria, continuing performance criteria for criterion for the government. There's a negative reaction with off the fund. The adverse impact on the power circular debt, that's something that will also flow through into our negotiations with the IMF. There's the negative or the adverse impact on the cash flow of the oil marketing companies. And we're already seeing in the last 1 or 2 days, red flags going up about the ability of PSO to import oil and sell petrol in Pakistan. So it's an unintended consequence, but it's not unseen. So I can share this with you. Many of us who were consulted by the government for the last 2.5 months, the EAC, myself, many of us worked on this package for the government, a completely different package. But when the government announced this or brought this to the table, we had actually forewarned the government about many of these, in fact, all of these adverse effects and unintended consequences. And of course, at a time when you want to rein in petroleum consumption in the country, this will actually do the opposite, and therefore it'll have an unfavorable effect on the trade deficit at a time when you really need to clamp down. So the external account outlook, of course, is dependent largely on 4 main sets of variables. So the international oil prices, which then in turn are dependent on at least 5 or 6 sub factors that you can see in the box next to that arrow. So how Russia, Ukraine plays out, the amount of oil spare capacity. And the reason I put this down is that at least when I was writing the report for KTrade, as many of you know who work in the international markets, especially look at the oil markets, Saudi spare capacity is one of the largest swing factors in the oil markets. And the Saudis have kept not just their actual production like many other OPEC members, but their spare capacity, available spare capacity, as a state secret. Literally, it is elevated to a state secret. And now, since then, it's come out gradually that the Saudis have 2 to 3 million barrels of spare capacity. So one, we're not really sure about this number, but even if that is the case, there's something bizarre that happens when the Saudis start dipping into that spare capacity, and the markets react adversely. This is really counterintuitive, but the markets, when Saudis start dipping into that spare capacity, oil prices actually have tended to go up rather than come down. The oil markets are not comforted by the fact that that thin spare capacity is now going to be eroded even further. So there are a lot of variables with the oil markets there. when that demand destruction will kick in, if it does kick in, but it certainly seems that there will be a recession at some stage, a global recession, but it's it's going to kick in at some later stage. And then, of course, our own policy mix is dependent on a number of things, the path of domestic inflation, the path of domestic politics, etc. And then there's the external debt repayments. These we know, of course, the ones that we've used are the known knowns, if you like. But then the amount of fresh borrowing that we undertake, what happens to US Fed tightening and when does it happen? What would that mean for our, access to the international capital markets, etc. So that's another unknown, slight unknown. And then related to this is the financing availability. Once again, the US Fed plays a big part of that, but so would the continuation of the IMF program. So putting all this together, at least our sort of thoughts, the best that we could see through this fog of war of, or the fog that is enveloping the markets. So what we see is that our current account balance is very elevated. Along with our principal repayments, that means our gross external financing requirement is probably around 10.5% of GDP this year, which is really high, and comes down slightly to about 8.5% of GDP. Next year, about $34 billion would be our gross external financing requirement. And the known flows that we could source, and some of them are up in the air. That FDI number, for example, is based on what the expectation is under phase 2 of CPEC, but that may not play out, and therefore we may lose that additional $1.5 billion from there. But nonetheless, even with those fairly benign projections on the inflows, we have a financing gap, net financing gap. So if you look at the last row, the change in FX reserves, net SPP. So a drawdown of $8 billion roughly this year. It's not happening so far as per, so obviously there are tricks of the trade that SPP does employ. Some of these things are kicked down the road. So in our Excel sheet, they're not kicked down the road, so they're absorbed entirely within this year. So reserves will not likely fall completely up to $8 billion. But mind you, keep in mind that the burn rate of reserves with the SPP has accelerated. So from August, the peak reserves, SPP reserves that we hit was in August 2021 of slightly over $20 billion. And we've moved to about $16 billion now. So in 7 months, an erosion of about $4 billion, slightly more perhaps, thereabouts. But in the last 1.5 months, we've lost about $1.5 billion of reserves. So the burn rate has increased. And therefore, I'm quite confident, unfortunately, that, given this trend, the next 3-4 months, we'll see a lot of pressure on SPP reserves as well. So I've here on this slide, I've just recapped. I'm not going to go through this. I've already mentioned, but the principal repayments and the IMF repurchases have been sourced from the latest IMF country report, right? So I mean, that's obviously some information that we didn't have. So we just taken it from there. So, I spoke about the impact of the political environment, the domestic politics on the external account. I think the second bullet point here is important. Something that I've, been in a position to raise with successive governments in the last 15-20 years, that, the last leg of a government heading towards elections is really when all the governments, going back to General Musharraf's, have laid the basis for Pakistan's next balance of payments crisis. This is no coincidence, right? So this is bad economic management, bad governance, but it's a recurring pattern, and we've seen it with this government as well. Now, of course, I've tried to conduct a what-if exercise here as well. And many of you would have, much more nuanced views than I have. Perhaps I'd love to hear your views as well in Q&A. But So what happens if the PTI government is toppled by a no confidence motion? We really don't know, because right now the talk of a national government is not constitutional, of course. Right. So how this is going to play out, whether there's going to be an interim setup and then new elections, or an in-house change, or whatever. I'm not sure. We're not sure. But one thing that's quite likely is that once the PTI government goes and is replaced by some form of PMLN and PPP, past experience indicates that, lo and behold, the international establishment becomes quite keen on Pakistan, quite keen to finance Pakistan. So I think that what that may do is it may kick the can down the road for Pakistan. I mean, these two parties, or any other party for that matter, uniformed, ununiformed, PTI, inclusive, but PTI is slightly relatively better, but nobody has had the brains, and I'm sorry, I'm being absolutely, brutal here. They haven't had the brains for what the economic reforms plan should be. They haven't had the gumption and the appetite for it, or the understanding that is required. So they'll only be able to, with that financing, kick the can down the road. And I have, little sort of confidence that things will improve under any form of, other government, unless it's a technocratic government supported by Pindi, which is unlikely to happen. So based on that external account, prognosis, of course, it doesn't portend well for the rupee. Every time, as you can see, which is intuitive, that the USD PTR has moved for a long time in line with the overall balance of the balance of payments, right? So if you get the overall balance right, i.e. the change in reserves, then of course you'll get some idea of what the rupee is going to do. And in my sort of in my external account or balance of payments model, this is subjective call what that means for the rupee, and based on just a subjective judgmental kind of view, I think what I'm predicting for the external account probably means a 7 to 10% depreciation of the rupee. This is a base case, mind you, so this is not the worst case. The worst case, of course, is worse. As the name implies, that's tautological, but so this is the base case of 7 to 10% depreciation for the rupee by June 2023. But a lot of volatility that we do expect in the second half of this calendar year. What would all this mean for inflation? Because clearly rupee weakness has not just the international oil prices, but the rupee weakness will also have an impact on inflation, and via that on the interest rate outlook. And here, so we've just run some simulations on an effective landed price, what the GOP pass-through is likely to be. Sorry, excuse me. And so we have an inflation, we have an econometric model for inflation. And that model has actually given us pretty good results for the last, since 2005. In fact, very good results. And if, of course, it all depends on the assumptions, and if our assumptions are correct on what, what the balance of payments would mean for the rupee, what international oil prices, that's a big wild card. If all that is correct, then GOP pass through to pump prices, to retail prices of 100% from July 1 onwards, let's say, would mean by June 30th, 2023, the CPI, even from these elevated levels, would still go up to about 12.8% according to our model, right? So irrespective whether it's going to be 12.8% or 11.5%, I think the takeaway from this slide is, if our assumptions are correct and they hold, then the inflationary outlook is going to remain elevated. unlike what the state bank believes, right? So they're talking about medium term, path coming down to about 7%. And I think this obviously doesn't bode well for the interest rate outlook. And so I wrote this, and this is exactly what I think, another sort of Citibank, I think, also wrote exactly the same thing as carried by Bloomberg, that it will be difficult for the central bank to ignore the impact of international oil prices. I think they will have to. So even if they maintain a neutral stance on a forward-looking basis, they would still need to hike their policy rate, maybe 1.5%, maybe up to 2%, depending on where the oil prices are. But of course, we know that the central bank is behind the curve deliberately. It's following a reactive policy function because they want to be growth supportive. And I think what that will mean is that they're probably going to hold off in May, if they call anything earlier than May, that's of course a clear sign that they're going to tighten. But in the normal cycle, if they hold off till May, then they may hold off in May as well, and then begin the tightening from July this year, depending on what the budget. The budget is clearly, if PTI stays in power, the budget is going to be once again nowhere a budget of fiscal consolidation. It's going to be a budget of once again, like the previous budget, an election cycle budget. So the central bank may have to do more, carry more of the weight, carry more of the burden to control the macroeconomic pressures. So this is my conclusion, that we are on a tightrope yet again. We're staring at the abyss, in the sense it's not happening immediately, but it's a slow motion implosion. And 2023 really is going to be a very tough year for Pakistan's economy once again. This is familiar habitat, unfortunately. I think we're heading towards, the finance minister should be aiming for soft landing, but clearly, he's not, political expediency is not dictating that. And therefore, I think that we will have a hard landing in 2023. And if the government is removed, which I think is quite likely now, on March 9th, I thought it was less likely. Today, I think it's very likely, unfortunately, from my perspective. Then what will happen is, I think there could be a reflation trade set up on the PSX by the international support that the new setup gets. But once again, like I said, it'll just be kicking the can down the road. It'll be a brief interlude before a challenging external environment reasserts itself. So I'll stop there. Thank you so much for listening, and I'd love to take your questions and comments.
Thank you, Sakib Saab. That was very detailed and very interesting, and slightly scary as well, given the challenges which the economy is facing, and especially the balance of payment situation and the political change. And I hope that there is some international support and flows which do come in case there is a change, but I'm not sure about that, given what's happening globally. So there are some questions already. Akbar, if you can, typically the way we take questions is if you write them on chat. If you want to say them loudly, I can also unmute you. So let me do that. You can unmute yourself and ask the question, Akbar, if you want, but typically it's easier if you just write it on chat and I'll read it to Sakib Saab.
Okay, thank you, Ali, taking the question. Thanks, Sakib, for a detailed presentation and insight. I have a couple of questions, and I'd appreciate if you get the insight onto that. I'm more interested in terms of understanding the timing of the monetary tightening, and that's obviously linkage with regards to the build-up that you've given on the external account and also on the inflation, driven primarily by the fiscal imbalances and also external environment. So from that perspective, the next 4 months, your assumption is obviously on a elevated oil price trajectory, which is obviously showing its impact on the current account. But at the same time, you're also looking at the IMF would obviously see an impasse, and also, by September, that program in any case is going to be sort of ended. So in terms of the monetary tightening timing, that's my core question, when the pressure is going to be the next few months and you're already expecting softening of, the commodity prices when running into FY23, then I just wanted to understand, the rationale of monetary tightening getting into the third quarter of this calendar year, perhaps, and not early, A. And also, if you can shed with regards to that, shed some light on your inflation projection, because the sensitivity that you've shown is basically on year-on-year number of, I believe, June 2023. And I just wanted to understand the average outlook for FY23, because I think that's just June 23, one point in time, year-on-year comparison. Thank you.
Right. Thank you. So basically, I think, we mentioned this in the report as well, and I think I mentioned it somewhere on the slide, but I didn't highlight it. So why, if on the face of it, it seems, contradictory when we're saying that we expect the average international oil price, to come down. So the path from, 140-ish level, which I predicted earlier, which has not happened. It happened for a brief while and then is moving around. Of course, it's volatile, and then we expect it to be average to 90 and then average to 60. Despite that, why do we expect inflation for there to be a pass-through to inflation in Pakistan? And the reason is, of course, that because the government has frozen the petrol, not just frozen, but they've actually reduced petroleum prices. So they've brought them down to roughly, let's say, about what would have been $88 to $90 in the international markets. So that's the price currently, the pump price that we are paying. And this is completely unsustainable, of course, as I've shown, in terms of the fiscal package, in terms of the IMF, and in terms of even the impact it's having on the balance of payments, the external account. Because you want to sort of obviously tighten your policies so that growth or imports slow down, but we've not done that. So at some stage we'll have to reverse this from July 1. Most probably we'll have to reverse this, and then over a period of time, the government is not going to do it overnight, but over a period of, let's say, a few weeks, a month, or a couple of months, the government will have to adjust that $88, $90 that we are paying, all of us are paying, the equivalent of that at the pump price, to, let's say, $100, $110, $120, whatever it is. And therefore, that's where the inflation then will start trickling through. So that's the thinking about. So the central bank, like I said, is going to be reactive. Then it doesn't have to react right now, because that inflation is going to, sort of pass through into the system, into the monetary transmission sort of, system in about maybe 4 to 6 months time, 4 months, or actually more than that, about 6 months, 7 months time. So maybe, they're not going to jump the gun and hold off, perhaps in July as well. But certainly by September, I think the pressure will start building up, because inflation from these elevated levels of about 12% or thereabouts, of course, it's going to come down a bit now, because in March, we'll see the full impact of that 10 rupee reduction and 5 rupee reduction in electricity tariffs and 10 rupee reduction in petroleum prices. So it's going to come off a bit in the next few months, but then it's going to pick up once again quite sharply. So, I mean, that's my thought process on why the monetary tightening cycle will truly be in play by September this year. That's what I feel. Sorry, your second part of the question I've forgotten was...
Thanks, Sakib. That sort of connects that, but it's just a small, if you allow me, just a small follow-up on this narrative. In that particular context, in terms of the timing or the drift, but there is also an element of the base effect on the inflation trajectory also. and perhaps if I add a flavor of the GDP growth, because we know with the change in the base and the 5.6% GDP growth, even State Bank of Pakistan not expecting FY22 growth to be higher than even 5%. So with that perspective, and the reason I was asking about the timing, that when getting into July to September quarter, that high base that we've already had, in FY22, that will also be kicking in, and that base effect will be there on the other side for inflation. And also when you have a lower GDP number coming out, July, August for FY22, both of these are sort of counterintuitive in terms of monetary tightening, by August, September and thereabouts, because your GDP will be year on year lower in terms of the growth trajectory. And also your inflation, that one aspect, that the pass on will take place in July. So that's right. But obviously that base effect, high base effect of this fiscal year will start to have its impact on obviously FY23 inflation outlook. So that was just sort of follow up on this. How do you see that GDP and inflation base effect kicking into the equation?
I think your argument about the base effect is absolutely correct. So it may sort of so happen that they get a favorable few months of inflation numbers, and they'll defer it from September. They could, I don't know. But I'm thinking the central bank, not just in growth numbers. Of course, they've been growth supportive right now. And they've also noted in the last or most recent monetary policy statement that aggregate demand is slowing down. We can see that from the numbers, and so that's why they're being reactive and behind the curve. We know that. But my sense is that with macroeconomic pressures building up, and the monetary policy function being on a forward-looking basis, I think they will need to pick up the slack by September. So that's the way I look at it. But you could be right that the base effect may keep them from doing that, and they may hold off for a bit later.
Thank you, Sakib Sahab. We have some questions.
Thank you very much.
Thank you, Akbar, for the questions. Taha Javid is asking that the monetary side seems to be very relaxed and behind the curve in its current account deficit and inflation forecast, while the fiscal side is also loose. What's your comment on that?
So, Taha, obviously, in the report, we've mentioned this, that this is completely inappropriate, the policy makes. And I mentioned this on 2-3 slides here as well, that, generally, this is completely behind the curve and inappropriate, and therefore something will have to give. And going back to what Akbar, so Akbar, just to reiterate also, and Taha, the reason, the premise, the hypothesis that we have is that because the government will be in election mode, it will, assuming this government stays, therefore the fiscal policy will not adjust, right, to take care of the potential balance of payments crisis that we see in 2023. Therefore, monetary policy will have to take on the additional burden, right? Because we're talking about an independent central bank now. So one would think that they would feel that responsibility to be ahead of the curve from July onwards rather than behind the curve. So that was pretty much the hypothesis. So going back to what Akbar was saying, and to answer your question as well, absolutely, I've been saying that, and I think something will have to give pretty soon, and it's not going to be fiscal policy. I think it's going to be monetary policy.
Thank you. Raza Agha is asking that should the current government fall, do you expect the current parliament to elect a new leader of the house, or do you think elections become more likely?
So hi, Raza. Personally, obviously it's very difficult to say, but I personally think that early elections are a more likely outcome. I can't see, so everybody's united at this point in time against PTI, but that unity will be severely tested as soon as PTI government is removed. I think the only outcome they'll probably all agree on is early elections.
Thank you for that. And we have 15 more minutes from Sakib Saab, so if you have more questions, do write it. Sakib Saab, I have a question that, how do you think the talks with IMF, what will be IMF saying to the government right now? And do you think that, it's that they will say, we won't give you, excuse me. Will they, will they have red lines on certain points, and will they be flexible, or do you think that the credibility hit now with them?
No, I personally think that there's no room for forbearance with the IMF. We've crossed all the red lines. So if you just go back and give it slightly, perspective of over about a year, last March, we finally sort of convinced them that we are serious once again about resuming the program or resuming our reform program, and we signed off with them in March. Some new program parameters were reworked, of course, because of COVID, etc., certain things. And then in June, just barely about a month or 2 months after that, sort of bringing back the IMF or coming back into the fold of the IMF program, in June, the finance minister announced a budget which is completely haywire in terms of the IMF program, or agreed parts of fiscal consolidation with them. So, now once again, we've sort of managed to convince them finally that yes, we're serious, or we had convinced them. And once again, we've torpedoed that, not just with anything. I mean, the tax amnesty was a continuous, not offering any new tax amnesty. We were in violation of that already. It was a continuous structural benchmark, and we violated it once again after agreeing with them that, we accept all your conditions. So I think I find it very difficult. I think the 7th review is torpedoed. I don't think there's very little hope that the government will come through successfully in this.
Unfortunately, plus hits the credibility that, how can you just swing so quickly on commitments? Mustafa Pasha is asking that, how do you see the flat yield curve and heavy bidding in the long tenor fixed PIBs around 11.5 to 11.75%? Has the bond market got it completely wrong? And then the second question is, and what do you think of alternative assistance materializing from China? That's a very interesting point that we used to hear a lot about Chinese support, and now that's not coming. We are not hearing about that, at least.
So, I mean, if I were to answer the China one first, once again, to be honest, I'm not a specialist in either. I mean, most of you know the bond markets better than I do. Many of you are practitioners, and I'm not. And once again, even with China, I'm not a China specialist, but clearly China has its hands full, in many other ways as well, especially with Russia, Ukraine. I don't think China is going to be a big factor. China is going to be a factor in the sense that, as most of you know, that the largest bit of external financing, firm external financing in the IMF program, it does come from not just fresh financing from China, but mostly in the form of rollovers from China. So that may continue, but I don't see large dollops of cash coming to Pakistan for any new government. Their assistance now has moved to a different level, I think, and that is under CPEC 2, trying to bring FDI into Pakistan and helping Pakistan in terms of exports, etc. So that may not change. Now, in terms of the bond markets getting it wrong, once again, like I said, this comes with a big health warning that I'm not a bond market specialist, but I do think that they've got it wrong, personally.
Thank you. Hassan Raza is asking that, assuming the PTI government loses power and early elections are called, and whatever sort of government is formed, what are options other than IMF and the economic implications of that? Then he's commenting that the reserve drawdown that you have shown of $8 billion each year in 2022 and 23 is quite scary. And when that happens, the currency will come under severe pressure.
Yeah, no, two things about that. The second bit of your observation is absolutely correct. So let me also give you, obviously I do have a fiduciary responsibility to be, as candid and as intellectually honest in presenting my views. But at the same time, when it comes to exchange rates, just keep this in mind that I've always avoided the last 15, 20 years or whatever, trying to induce any sort of panic. So yes, this does induce panic when you see reserves falling, each year by $8 billion, roughly. That means in 2 years, they should be down to zero. But the implications of the exchange rate that I mentioned may be slightly more, maybe milder than, simply because I don't want the market to go into any sort of panic. But nonetheless, the broad picture is out there, I think, in terms of what it shows for the numbers.
It is. And the first part of his questions was that besides IMF, is there any other source of funding which Pakistan can have?
So assuming, of course, it's very likely that, either PMLN or PPP or PMLN and PPP will be in some shape and form, part of any new setup or any new government. They've never shied away from going to the IMF. So in the report, I had a table on the number of programs each government has done. So I think there was 6 for PPP, 4 for PMLN or something to that effect. You can switch them around, I forget now who did what. So, and their international backers have generally, so I can talk about the 2008 program, for example. I was involved in that as the principal economic advisor at the Ministry of Finance. So it was very clear, the message that we got from the White House was that, don't look for bilateral assistance. We'll channel all our assistance through a very large multilateral program, IMF, World Bank, ADB, etc. And if many of you would recall that we signed off on, I think, the biggest program in Pakistan's history of $11.2 billion. This was about 410% or 425%, I forget, of our quota. We drew down about $7.2 billion eventually, but the actual program size was $11.2 billion. So this is precisely, I think, the model that, and that was a Democratic White House as well. And I think this is the playbook that the Biden White House will probably follow as well.
Okay, so hopefully, that's some kind of silver lining that, if political relationship can improve with the new government over here, then perhaps.
Ali, badi afsos ki baat hai. You want the PTI government to go? I don't.
Yeah, neither do I. Neither do I. I'm a big supporter, but I'm just saying that in terms of economic implications. Otherwise, I've written a lot in support of the Prime Minister. As you said, like that, if we just look at the writing on the wall, then the trend, if we extend the trend, then that just looks very ugly from an economic perspective. You also mentioned while you were talking that when the government was discussing this recent relief plan, you did highlight the risks, which you mentioned on the slide over there in your presentation. What could have been an alternative plan? And when you were discussing the risks, and then do you think that they are conscious of the risks, despite that they didn't have any other options, or was there an alternative, better policy which you could have done?
No, certainly. I think there were much better policy options, because what we had suggested was, and this is pretty much in the public domain, so I can talk about it. Many of our EAC members have come on TV since then, and given the views as well. So what we were talking about, or we were pushing for, was a much more targeted plan of action. So one of the things that we discussed at length for about 2 months, and I think it got stumped because of the modalities, we couldn't sort those out, was the potential to issue fleet cards or fuel cards for motorcyclists. and give them, so these are smart cards, and using, the smart card that we used for the flood relief program in 2010, 11, and the Benazir income support card. So we put a cap on, let's say how much fuel they can purchase in a month, or stuff like that. So that was one option. The other option was loading some more cash onto the Esas Russian program, or expanding its ambit. So right now you can only purchase with registered Karyana stores, you can only purchase 3 items: cooking oil, pulses, etc. And there you add on a few more items. So we had a much more targeted approach, and it was with a sunset clause, etc., etc. But I think the government was quite under pressure, not because of elections, but because of the no confidence motion. I think that was the primary driver.
Got it. No, thank you for that. Raza Aga wants to ask a question. Raza Bhai, if you want, you can just ask the question yourself.
Assalamu alaikum, Sakib. Thank you very much for a great presentation. It's a difficult one. Do you think, given the external financing situation, the drawdown in FX reserves that may happen, do you think a debt restructuring is inevitable, or they can avoid a debt default?
That's a great question, Raza. Personally, I mean, if I was to advise any future government, I would personally think, and this may shock some of you, but I would think that we would need to go into. Actually, it would be good for Pakistan if we can get a Paris Club rescheduling, but not a London Club, obviously, but a Paris Club, some sort of haircut. But of course, as you know, that has attendant, sort of consequences. But I think our debt buildup vis-a-vis our foreign exchange earning ability, primarily our export base, is now completely out of whack. And I think that's the only, at some stage, that's probably the only option that we will have.
Scary. We have one question from Zahid Khan, and then we'll go to Taha. I think Taha wants to ask another question. So Zahid Khan is asking that what steps the current government should take if it wants to solve the economic situation, assuming that it remains in power, especially in the context of high commodity prices. I suppose this question is that, was it all external just because commodity prices are too high? So that's another implication of his question.
Yeah. So Zahid, I think obviously, since we're price takers in terms of international commodities, that pass-through we couldn't have avoided. But the government compounded the situation last year with its, they opened the spigots, so to say, with that budget last year, that growth strategy, which is the favorite of all Pakistani governments, even though it gets us into trouble every 7 to 8 years, or thereabouts, or even earlier. I think that compounded the pressure on the rupee, and through that, the pressure on inflation, and through that, pressure on the government. So that part of the economic management is completely self-inflicted. What can they do now? I think nothing in the short run, to be honest. I think they just need to they need to work through this. Of course, there's some trade-offs that will have to take into, will come into play. So in order to ensure that Pakistan, or they don't hand off to the next government, assuming that, they survive the vote of no confidence, they survive into 2023, their elections on schedule, and they hand off to another government, whether it's a PTI government or another government, they're certainly going to hand off a balance of payments crisis to that next government. So they have to, it's their fundamental responsibility to ensure that they follow some prudent, economic policy making from now onwards, and not just, sort of subjugated to political expediency. And for that, they'll need to start tightening up their fiscal act, the fiscal side of the policy slowly, so they'll have to sacrifice their political, at some degree of political capital for that, but I think that's the price they have to pay. Whether it's asking too much for a political government and embattled political government, I think it is, to be honest.
So not too many options. Taha, you want to ask a question? I see a raised hand.
Yeah, thank you, Ali. Sakib sir, just two small things. On the export front, obviously, it's a big structural issue, and despite about 60% devaluation, we're still unable to really grow the exports. So why do you think that is? And is there any silver lining that we may be able to raise our exports in IT or things like that, views on exports? Because imports continue to remain inelastic, while exports have obviously been disappointing. And secondly, about your comment on IMF and the US relationship, I would beg to differ that obviously 2008, and at that time it's a different US-Pakistan relationship, and obviously post-Afghanistan pullout and India being more of a trusted ally now versus China, I think Pakistan, whatever Pakistan wants, I don't think we're going back to that kind of a relationship. Your thoughts on that?
It's possible, Taha. It's entirely possible, but I think the perspective behind the 2008 thinking has not changed in the Democratic White House or in the Democratic Party. And the perspective is, so PMLN and PPP, but PMLN primarily is much more aligned with the US's regional, regional sort of plans. So they talk about, they're very happy to give MFN status to India, talk about regional connectivity and start practical work on that front. More importantly, the democratic agenda for the last 15-20 years vis-a-vis Pakistan has been, or perhaps even longer, is to bring the military under civilian control. And that agenda has not changed. And in order to support that agenda, they need to support the civilian government. And in order to support the civilian government, it's the exact playbook that they'll follow, that they followed in 2008, which is pump money into the system, into the civilian government, and then also have Kerry Lugar kind of bills out there. So I think, personally, I think the playbook is going to stay the same, but it will be interesting to see. Sorry, what was the other question, Taha, that you had?
On the exports front, we haven't seen any rise as such.
No, yeah, I personally think, all this criticism about the devaluation not filtering into exports, I think it's wrong on 2 counts. In fact, it's wrong on 3 counts. The first count is, why do we think that Pakistan operates in some other universe? Every fundamental thing that applies, whether it's physics, biology, chemistry, or economics, that applies to anyone else in the world applies to Pakistan as well. So this devaluation thing is simply wrong because, one, if you look at the export volumes, because the theory tells us that it's not your export dollars that will be impacted as much as export volumes you'll start exporting more in terms of quantity, right? So whether you get those prices or not, that's a separate matter. But we're exporting tons more today than we were 3 years ago in terms of export. The quantum, if you look at the quantum index of exports in the last few pages of the State Bank monthly bulletin, statistical bulletin, you'll see what I'm talking about. It's a 70% increase roughly in the index value in the last 3 years. So we are exporting more. The devaluation has played a big role. And why has it not played as big a role as we thought it would? Simply because these devaluations are not competitive devaluations. You are doing a devaluation when your foreign exchange reserves have hit rock bottom, when your asset markets, your financial markets are falling like 9 pins, and your business sentiment is obviously falling as well, and you expect exporters to step in and sort of start exporting. No, when we do competitive devaluation, it's only then that you see an impact on export volumes in a much bigger way as predicted by the theory. So because we went through a restructuring of the last a debt restructuring sort of the last 2-3 years, therefore the impact is more muted. But if you look at the export volumes, the impact is not as muted as you see in terms of dollar values.
Thank you, Sakib Saab. We have run over time, and we had requested you for an hour, and it's 4 minutes ahead. But I'll just put in the last question that's come from Hassan Raza, and he's asking about, you mentioned about global recession, and can you give us some color on what you think the global economy would do, especially with Fed raising interest rates?
So I think it's quite clear. In fact, it would be great to hear perspective of people like Raza who sit outside and look at the markets more than I do, even yourself, Ali. But my sort of question to a WhatsApp group that I'm on a few days ago was, why aren't we hearing more people talk about stagflation? So we were a year ago. And then it's relatively quite more muted than I thought it would be. So personally, I think with oil prices going to remain elevated, if that's the correct view, I mean, even at $90, average $90, they're fairly elevated, and other commodity prices, etc. And it will have a knock-on impact on global growth, the whole sanctions regime, the counter sanctions, etc., etc. So I think we're heading to a situation where, I mean, growth certainly is going to be a casualty, but I'm more worried now, not just of a normal kind of a recession, but of the possibility of stagflation. And I think I can see some hints of it on the horizon. Whether it happens or not is, I'm not sure at this point in time.
No, thank you. Yeah, and with inflation 40 years high, like running at 6-7%, which is like emerging markets inflation, certainly that's stagflation is the key risk. Thank you, Sakib Saab, for your time and your insights and your report. This was extremely helpful and valuable for us. So thank you for this.
Okay, take care, everyone. Love it.
Good office.